There is a question that gets asked constantly in financial media right now and almost always answered the wrong way. The question is the dollar losing its reserve currency status? The typical answer goes like this. The dollar still accounts for 58% of global trade settlement. The yuan accounts for less than 3% of global SWIFT payments. The US Treasury market, at over $25 trillion in outstanding debt, is still the deepest, most liquid sovereign debt market on the planet. China has capital controls. The yuan is not freely convertible. BRICS has no unified currency and no credible plan for one. The dollar is not going anywhere. This answer is technically accurate, and it misses everything that matters. Because the question was never whether the dollar would be replaced overnight. Currency reserve dominance does not work that way. The British pound did not lose its reserve currency status in a single year. It lost it over decades. Through the accumulation of small shifts, each individually manageable, each explicable by temporary factors, each dismissed by those who were watching closely, until the system had already pivoted and the pound's dominance was an anachronism being maintained by institutional inertia. The dollar is not dying. Something more structurally significant is happening. Its indispensability is eroding, quietly, measurably, across multiple fronts simultaneously, and the combination of fronts, the simultaneity of the erosion, is what makes 2026 different from every previous year in which analysts have been asked the same question and given the same answer. This is Capital Briefing. If you are here for the first time, subscribe now before we go further. Turn on notifications. What we build on this channel is the translation of what institutional capital is doing before the public narrative catches up. The gap between when structural shifts begin and when they become headlines is exactly where the most consequential wealth transfers in financial history occur. Subscribe now. Then let me show you what the data actually says. Let me start with the number that defines the structural context. 72%. That was the dollar's share of global foreign exchange reserves in 2001, the peak of the post-Cold War unipolar moment, the apex of what some economists called the dollar's structural monopoly, the point at which virtually all meaningful international financial transactions flowed through dollar-denominated systems. That number is now below 57%, the lowest it has been since 1995. 25 years of slow, steady, documented erosion, not a collapse, not a replacement, an erosion. The distinction matters because erosion is psychologically invisible in ways that replacement is not. When a currency is replaced, there is a clear before and after, a moment when headlines announce the shift. When a currency erodes, the process happens in thousands of small transactions, bilateral deals, and reserve reallocation decisions that each look individually insignificant. By the time erosion becomes a headline, the structural shift has already occurred. That is the first thing to understand about what is happening to the dollar right now. The second thing to understand is the mechanism. The dollar's reserve currency status is not merely a function of trust in American institutions or the depth of US capital markets, though those matter. It is a function of a specific structural arrangement that was built in the early 1970s and has operated as the invisible architecture of American financial power ever since. That arrangement is called the petrodollar system. Here is how it works in its simplest form. Oil is the most traded commodity in the world. Roughly $2 to $3 trillion of oil changes hands globally every year. Since 1974, virtually all of that trade has been denominated in US dollars. This is not a law, it is not a treaty. It is a commercial convention backed by a specific geopolitical arrangement. In 1974, Saudi Arabia agreed to price all of its oil exclusively in dollars and to reinvest its surplus earnings into US Treasury bonds. In return, the United States provided military protection for Saudi oil infrastructure. Every other OPEC member eventually adopted the same convention. The consequence was structural and self-reinforcing. Global oil demand created global dollar demand. Oil exporters accumulated dollar surpluses. Those surpluses were recycled into US Treasury securities. This recycling compressed US Treasury yields, allowing the United States to finance its deficits at artificially suppressed borrowing costs. Lower borrowing costs enabled greater spending. Greater spending enabled the projection of military and economic power that sustained the arrangement. This is the loop that has underwritten American fiscal dominance for 50 years. And this loop is now under the most operationally credible stress it has faced since 1974. Subscribe to Capital Briefing if this framing is delivering the structural context you have been looking for. Turn on notifications. The next video examines the specific mechanisms through which petrodollar recycling suppressed US Treasury yields for 50 years and what the mathematical consequence of reduced recycling is for American borrowing costs over the next decade. Subscribe now, then let me take you to the Strait of Hormuz. In March 2026, something happened in the Strait of Hormuz that most financial commentators dismissed as a wartime anomaly. It is not a wartime anomaly. It is a structural precedent. The Strait of Hormuz is a 21-mile wide channel between Iran and Oman, through which approximately 1/5 of global oil and liquefied natural gas normally transits. Every day, roughly 110 vessels pass through it. That traffic represents the physical backbone of the petrodollar recycling loop. When U.S.-Israeli military operations against Iran began in late February 2026, Iran effectively closed the strait to vessels linked to the United States and its Western allies. Daily ship transits plummeted from approximately 110 to fewer than 10. But here is the part that is not a wartime anomaly. Iran began offering conditional passage, allowing certain vessels through the strait on the condition that transit fees were settled not in US dollars, but in Chinese yuan. According to reporting confirmed by Lloyd's List, at least 2 vessels had made payments in yuan as of March 25th. China's Ministry of Commerce acknowledged the arrangement in a social media post. Iran's embassy stated publicly that it was time to establish the petro-yuan in the global oil market. This is the first documented instance in the history of the petrodollar era of a systematic non-dollar transit fee requirement being imposed on a corridor carrying a substantial fraction of global energy supply. It is not the end of the petrodollar. The Asia Society Policy Institute's January 2026 report noted that complete de-dollarization of the oil trade is highly unlikely over the next 5 years. But it is qualitatively different from everything that came before. Every previous act of de-dollarization was a marginal adjustment, a bilateral trade deal, a reserve reallocation, a swap agreement between secondary powers. This is Iran deploying military control of the world's most strategically critical energy corridor as a lever to enforce a financial condition. The distinction, as one analyst described it, is that Iran is doing with gunboats what Beijing could never do with white papers. Now let me connect this to the broader pattern that preceded it. Because the Hormuz episode did not emerge from a vacuum. It emerged from a decade of infrastructure construction that made it operationally possible. China's cross-border interbank payment system, CIPS, processed 750,000 transactions valued at approximately $270 billion in a single month as of March 2026. The system now connects nearly 1,600 participants across 117 countries. Its annual transaction volume reached $25 trillion in 2025, a 43% increase from the prior year. BRICS nations now settle approximately 67% of intra-bloc trade in local currencies, up from less than 20% a decade ago. Russia and China now conduct approximately 90% of their bilateral trade in rubles and yuan. India settled 60 million barrels of oil imports per month in yuan and dirhams as of March 2026. Saudi Arabia, which ended its exclusive commitment to dollar oil pricing in June 2024, has built a $7 billion currency swap with China and participates in the mBridge multi-CBDC payment platform. The infrastructure for non-dollar oil settlement did not appear in response to the 2026 war. The 2026 war revealed infrastructure that had already been built over the preceding decade. That is the pattern that institutions are watching. Not the event, the infrastructure that made the event possible. Now let me explain why this matters for US Treasury demand, because this is the mechanism through which de-dollarization reaches into every portfolio, every pension fund, and every fixed income allocation in the world. The petrodollar recycling loop works as follows. Oil exporters earn dollars. They have more dollars than they need for their domestic economies. They invest those surplus dollars in the safest, most liquid dollar-denominated asset available, US Treasury bonds. This creates a permanent structural buyer of American sovereign debt, one whose purchasing is driven not by investment returns, but by the mechanics of the oil trade itself. This structural buying has for 50 years compressed US Treasury yields below what they would otherwise be. Economists estimate that this compression is worth 50 to 100 basis points in long-term Treasury yields, meaning that if the petrodollar recycling loop did not exist, U.S. government borrowing costs would be roughly half a percentage point higher than they currently are. At $39 trillion in outstanding debt, a half percentage point difference in borrowing costs is approximately $200 billion per year in additional interest expense. This is the fiscal mechanism at the heart of the dollar's structural privilege, and it is now showing measurable signs of strain. Japan, the largest foreign holder of U.S. Treasuries at $1.2 trillion, has been reducing its Treasury exposure as domestic Japanese bond yields have risen to multi-decade highs. The Bank of Japan has raised rates to 0.75%. The 10-year Japanese government bond yield is now approximately 2.3%, compared with around 1.3% on a fully hedged U.S. Treasury investment. Japanese investors are repatriating capital. Ministry of Finance data shows net sales of foreign securities totaling $25 billion since the start of 2026. China, the third largest foreign holder at $0.7 trillion, has been on a declining trend for a decade. The Chinese government reportedly advised banks to hold off on new Treasury purchases ahead of bond auctions in early 2026. The Federal Reserve's custody holdings for foreign official accounts slipped $8.7 billion in the single week ending May 6, 2026. At the same time, Japan was intervening in currency markets, raising the possibility that yen defense involved Treasury sales. None of these events individually constitutes a crisis. Together, they describe a structural shift in who is showing up to buy American sovereign debt, and at what price. When the structural buyers reduce their participation, the marginal buyer of U.S. Treasuries shifts toward domestic private investors and price-sensitive international funds. Price-sensitive buyers require higher yields to hold the same amount of risk. Higher yields mean higher borrowing costs for the U.S. government. Higher borrowing costs compound the debt arithmetic that is already at historically extreme levels. This is not speculation. This is mechanism. Let me now address the counter-argument directly, because it is real and it deserves serious engagement. The dollar is still the world's dominant reserve currency. The yuan is not freely convertible. China's financial markets are not open, transparent, or liquid enough to absorb the reserve function currently served by U.S. Treasuries. The legal and institutional infrastructure that surrounds dollar-denominated markets, American property rights, the rule of law, the depth of U.S. capital markets, has no credible substitute. Every one of these points is accurate, but they answer the wrong question. The question is not whether the dollar will be replaced. The question is whether its indispensability, the structural premium it enjoys, by virtue of being the only viable reserve currency, will continue to compress U.S. borrowing costs, enable persistent fiscal deficits, and allow dollar sanctions to function as effective tools of foreign policy. Indispensability is binary in theory. In practice, it is a spectrum. At 72% reserve share, the dollar's indispensability was structurally unchallenged. Alternative infrastructure was non-existent. At below 57% reserve share, with CIPS processing $25 trillion annually, with 67% of BRICS trade in local currencies, with yuan transit tolls at Hormuz, with Saudi Arabia ending its exclusive dollar pricing commitment, with Japan reducing treasury exposure, the dollar remains dominant, but its structural structural monopoly is visibly thinner than it was. Thinner structural monopoly means less compression of US borrowing costs. Less compression means higher yields needed to clear Treasury auctions. Higher yields mean accelerating the fiscal arithmetic that is already stressed at $39 trillion in debt and $1 trillion in annual interest expense. This is the chain. It does not require the dollar to be replaced. It only requires the erosion to continue. Now let me describe what institutional capital has been doing in response to this pattern, because this is where the capital briefing analysis always returns. What smart money is doing, not what it is saying. The most direct institutional response to de-dollarization pressure is the central bank gold accumulation story. Central banks purchased approximately 244 tons of gold in Q1 2026 alone, up 3% year over year. The National Bank of Poland is on a multi-year plan to reach 700 tons, reflecting explicit concern about Eastern NATO flank security. The People's Bank of China has increased its gold reserves to 2,313 tons, adding 7 tons in Q1 2026. This is not investment behavior in the traditional sense. Gold pays no yield. It generates no cash flow. The only reason to hold it in preference to Treasury bonds is a structural judgment that dollar-denominated reserve assets carry geopolitical risk that gold does not. The freezing of approximately $300 billion in Russian central bank assets in 2022 was the catalytic event. It demonstrated to every central bank in every country that had ever done anything the United States disapproved of that dollar reserves are not neutral assets. They are assets that can be confiscated by a geopolitical decision made in Washington without prior notice. Gold cannot be sanctioned. Gold cannot be frozen. Gold cannot be confiscated remotely. That calculation, not investment return but sanction immunity, is what is driving the structural allocation away from treasuries and toward gold. Smart institutional capital does not follow central banks' reserve decisions in real time, but it reads the signal that those decisions are sending. The signal is this: the entities responsible for managing the world's monetary reserves have concluded that a portion of their holdings must be held in an instrument immune to the geopolitical weaponization of the dollar system. That is not a fringe view. That is the documented behavior of the world's monetary authorities, visible in IMF reserve statistics and World Gold Council quarterly data for anyone who wants to look. Let me close with the framing that I believe is most useful for understanding what you should actually do with this analysis. De-dollarization is not a single event that happens on a specific day and causes a specific reaction. It is a structural transition that unfolds across decades, visible in aggregate through dozens of small decisions that each look individually inconsequential. The British pound's decline as global reserve currency unfolded over 30 years between 1914 and 1944. During that period, there were many individual moments when analysts correctly noted that the pound was still dominant, still the most widely used settlement currency, still the reference point for most international trade. They were right in each individual moment. The structural trend was moving against them anyway. The same analytical framework applies to the dollar today. The dollar is still dominant. Correct. The structural trend is moving against it. Also correct. These two statements are not in contradiction. They describe the same transition at different temporal scales. For the investor watching this right now, the actionable insight is not to abandon dollar-denominated assets or bet on imminent collapse. The actionable insight is to understand that a portfolio built entirely on the assumption of permanent dollar structural monopoly, with no allocation to assets that benefit from reduced dollar indispensability, is a portfolio that was optimized for a world that is measurably changing. Gold, non-dollar sovereign bonds, commodity exposure, and assets that perform when treasury yields rise rather than fall. These are not fringe allocations. They are structural hedges against a documented trend that has been running for 25 years and is visibly accelerating. The dollar still rules the world. For now. Subscribe to Capital Briefing now if this video changed how you read the structural shifts happening beneath the surface of global finance. Turn on notifications. Leave one comment, one word if you want. When you think about your current portfolio, how much of it depends on the dollar's structural monopoly remaining intact? Because the smart money has already asked that question, and the repositioning has already begun.